I'm a big proponent of REIT investing. I post weekly videos here on YouTube and I invest a significant portion of my net worth in them. I think that they're today offering a historic opportunity because they are trading at decade-low valuations, even as interest rates are expected to be cut in the near term, which I expect to lead to a strong recovery. Historically, whenever REITs have been so cheap relative to the net asset values, they have strongly outperformed in the following years. I don't think that this time will be different, and that is why I'm so bullish on REITs. However, that doesn't mean that I'm buying REIT ETFs like the Vanguard Real Estate ETF, ticker symbol VNQ, or the Schwab US REIT ETF, ticker symbol SCHH. They can make sense for some passive investors who don't know much about the REIT sector, are not interested to learn more, don't want to monitor their positions, and just want instant diversification at a low cost to earn market returns, which are quite respectable in the REIT sector. In fact, REITs have even outperformed the S&P 500 and tech stocks over the past 50 years. So why not just keep it simple, invest in an ETF and call it a day? Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and in today's video I'm gonna give you 3 reasons why I'm not buying REIT ETFs. The last reason is especially important because I will list some individual REITs that I would avoid buying. So make sure to listen till the very end. The first reason why I'm not buying REIT ETFs is because the sector is still relatively inefficient today. Studies show today that it has become nearly impossible for active investors to outperform the broader stock market. That's because it has become highly efficient with thousands of investors studying the same information, looking for opportunities to earn alpha. As a result, new information gets priced in really quickly, and profiting from inefficiencies has become really difficult, especially after fees. But this doesn't apply to the REIT sector. It's one of the few remaining sectors that remains notoriously inefficient today. According to a recent study by the investment firm Cohen & Steers, most active REIT investors outperform their benchmarks over the past 3, 5, and 10 years after fees. The reason why most active investors outperform their passive benchmarks in the REIT sector is simply because the sector is still far less competitive. What you need to understand here is that most real estate investors don't really trust the stock market, while most stock market investors have little knowledge about real estate. And as a result, there are relatively fewer knowledgeable investors in the REIT sector, and this results in many more pricing inefficiencies. Another source of mispricing is that there is a significant mismatch in the time horizon of your typical stock market investor and your typical real estate investor. Most stock investors are highly focused on near-term results. All they care about is the next quarter, the next year at most, and as a result, these short-term results will typically have a very significant impact on the valuation and the stock price performance of a given company. Most real estate investors, on the other hand, are very long-term oriented. They understand that real estate should be priced based on decades of expected future cash flow, and therefore short-term results don't have a significant impact on the valuation of the real estate. Despite that, REITs will commonly sell off very significantly due to short-term setbacks because they trade in the stock market and most investors are short-term oriented, creating opportunities for active REIT investors who can think like a real estate investor. To give you a good example, the mall REITs like NAREIT, Simon Property Group, and Tanger crashed really hard early in the pandemic because their tenants were not able to operate their stores, they were skipping rent payments, and as a result, these REITs reported really poor results. But any long-term oriented investor would have understood that this situation was truly exceptional, it was unlikely to last forever, and meanwhile the 0% interest rates would greatly support the valuation of the malls over the long run. Even then, the share prices of these REITs crashed as if the end was near. REITs like Simon Property Group saw their share price dropped all the way to $50 per share, which represented back then an estimated 75% discount to its net asset value. This is the typical valuation of a company that's about to go bankrupt, but in the case of Simon Property Group, it has an A- investment grade rating, significant liquidity, bankruptcy wasn't a concern, and this was simply an inefficiency. The market had overreacted to short-term results, and as a result, just a couple years later, the company saw its share price more than triple. This was a great opportunity for active investors like myself to profit from the inefficiency of the REIT market, and so that's what we did. At High Yield Landlord, I remember buying shares of Simon Property Group in the $50 to $60 range, and just recently we sold our stake at $172 per share. That was in the past, but I can now give you an example in today's market. Kite Realty Group is a retail REIT that we like a lot at the moment because it has historically enjoyed sector-leading same-property NOI growth. It has also the strongest balance sheet in its sector, and yet it trades at a discount relative to most of its peers. We think that this discount is entirely because of temporary factors. The REIT is expected to enjoy slower growth than its peers in 2025 because it has a bit more bad debt from its tenants, but we think that this will lead to an acceleration in its growth in 2026, which could then lead to some multiple expansion and upside. Once again, we think that the REIT market simply overreacted to short-term news, forgetting that real estate should be priced based on decades of expected cash flow. The REIT market is still very inefficient today, offering a lot of opportunities for sophisticated investors to profit from these mispricings, and therefore I don't want to be invested in an ETF. The second reason why I don't invest in REIT ETFs is because most of them are market cap weighted, and as a result of this, they will mostly invest in large cap and mega cap REITs. The problem with that is that most investors tend to buy these same stocks, they receive a lot of analyst coverage, and as a result, they typically trade at large premiums relative to their smaller and lesser known peers. In today's market, small cap REITs are trading at a 30% discount relative to large cap REITs, and that's despite in some cases enjoying even faster growth prospects, because a smaller size in many cases may allow you to grow faster as each new acquisition has a larger impact on your bottom line. Sometimes this valuation premium is justified by a stronger balance sheet, larger economies of scale, better access to capital, and so on. But in other cases, the spread is just too significant, and we see an opportunity to earn higher returns by investing in these smaller REITs that typically don't represent a significant weight in these ETFs portfolios. Hey, before I go into the third reason, can you please do me a huge favor and click the like button if you think that this content is helpful? Thanks so much in advance. The third reason why I'm not a big fan of REIT ETFs is that they are typically too spread out. They are not in the business of picking and choosing, and as a result they end up investing in the good, the bad, and the ugly in the REIT sector. This means that they will invest in externally managed REITs that suffer significant conflicts of interest and have long track records of being persistent underperformers, and we see no reasons why this would change anytime soon. This also means that they will invest in a lot of property sectors that are facing long-term headwinds. As an example, these ETFs hold significant stakes in office REITs, which are today facing all-time high vacancy rates, and I expect the pain to only grow further as the AI revolution takes hold. They also invest in a lot of hotel REITs, which are facing disruption from Airbnb, booking websites, and Zoom also now reducing the demand from business travelers. Finally, they invest in mortgage REITs, which have historically earned really poor results relative to traditional equity REITs. Over the past 20 years, they've earned only about 2% average annual total returns, and that's because their business models are just too dependent on macro factors that are unpredictable and out of their control. Yet these ETFs will still hold stakes in these mortgage REITs, which hurts their performance. I think that by simply skipping certain segments of the REIT market, like again mortgage REITs, hotel REITs, externally managed REITs, and many more, REIT investors can already outperform the averages, and that's not difficult to do. So in short, I think that ETFs and index funds make a lot of sense for most sectors of the markets because they become very efficient, and studies prove this. But the REIT market is different. This is one of the few sectors that remains inefficient. Studies prove this. Active investors have historically beaten passive strategies, and I think that I can be one of those active investors that outperforms the market, as I have a unique background that combines private equity real estate experience with my CFA education, which then allows me to be more knowledgeable than your average REIT investor, allowing me to identify opportunities to profit from these mispricings and earn higher returns. Since we launched our core portfolio at High Yield Landlord, we've earned roughly 4 times higher total returns than the MSCI US REIT Index, which is a very commonly used index by active investors. And I think that this outperformance will only accelerate as we recover from this recent bear market. If you want to learn more about our track record, I will put a link in the description of this video that will redirect you to an article for a more detailed description. Once more, thank you very much for clicking the like button and subscribing to the channel. Helps me a lot to keep on growing. Let me know what REITs I should cover next in the comment section. See you at my next one. Bye bye.